Now we're moving into our section on special deductions. So thinking back to our tax formula, we started with gross income, we subtracted deductions and losses, and those were our section 162 ordinary, necessary, reasonable deductions. We talked about charities, we talked about just general business deductions. We got to taxable income before special deductions, and from there we subtract special deductions. The dividends received deduction is going to allow a deduction of dividends received from a corporation in which the recipient corporation is a shareholder. The deduction is going to depend on how much the shareholder owns of the corporation. So if the shareholder owns less than 20% of the corporation, the recipient corporation can deduct 50% of the dividends received. If they own between 20 and 80%, the recipient corporation may deduct 65% of the dividends received. Notice the recipient has to be a corporation for this to apply. There are also limitations. So if we fall into the less than 20% ownership, our deduction is going to be limited to half the dividends or half the taxable income without regard to any net operating loss deduction, the dividends received deduction, or any capital loss carryback. All right, so remember that if we own less than 20%. If we own between 20 and 80%, we're going to be limited to 65% of the dividends received or 65% of the taxable income without regard to any net operating loss deduction, dividends received deduction itself, or the capital loss carryback. And it's the lesser of those two. So the lesser of the limitation, the lesser of the percentage of dividends or the percentage of taxable income. If you receive dividends from both categories, so if you own shares in multiple corporations, some you own less than 20%, some you own between 20 and 80, you'd have dividends in the 50% category and the 65% category. If that applies to your corporation, you apply the 65% dividends first, and then you reduce the taxable income, and then apply the 50% dividends. This limitation will not apply if it creates a net operating loss, if the corporation has a net operating loss. If you have affiliated groups, you can claim 100% dividends received deduction, and we will cover affiliated groups in detail in Chapter 8. There's also a 45-day rule. This says a corporation can't claim a dividends received deduction if it holds the dividend paying stock for less than 46 days during the 91-day period that begins 45 days before the stock becomes ex-dividend with respect to the dividend. And this is to prevent abuse because I could buy a stock, receive a dividend, and then sell it at a discounted rate when the share price falls, because we know when a corporation pays a dividend, the share price is going to fall because there are less assets in that corporation. So I could buy a stock, get a dividend, get the dividends received deduction, so not pay as much tax on that dividend, and then sell the share at a lower price, so also take a loss. So that would be abuse. We'd get a lot of tax benefits from doing that, and that's why the 45-day rule exists. We also have a limitation on the dividends received deduction if we finance stock with debt. The DRD is not allowed when a corporation borrows money to buy stock. Absent this rule, interest would be deductible and the dividend could be partially excluded from income, so we feel like Congress feels like that's a double benefit. So in exercise 3-39, we have Theta Corporation reporting the following results for the current year. Gross profit on sales, dividends from less than 20% owned domestic corporations, and operating expenses. And we want to know the taxable income for the current year. Okay, so in Part A, first we start with gross income. Gross income includes gross profit on sales, and it also includes dividends. This is income. So we add those two together, we get gross income of $320,000. From there, we're going to subtract deductions and losses. And it tells us here we have $218,000 of operating expenses. That's going to fall in our deductions and losses category. That leaves us with $102,000 of taxable income before special deductions. The dividends received deduction is a special deduction that's going to apply here because we're receiving dividends. We're a corporation who's receiving dividends from another domestic corporation. We own less than 20%. So that 50% limit is going to apply. And you can see down at the bottom, I have note, the dividends received deduction is the lesser of half of the dividends or half of the taxable income before special deductions. So our taxable income is $102,000. So the 50% of taxable income limit would be $51,000. Half the dividend is $50,000. So that is less. So the dividends received deduction in Part A is going to be $50,000, leaving taxable income at $52,000. In Part B, we want to know how the answer would change if the operating expenses are now $234,000. All right, so in Part B, it's the middle column. I have B up top. In Part B, nothing is going to change with gross income. We still have gross profit and we still have dividends. Those amounts haven't changed. But our operating expenses have gone up, which means our taxable income before the special deductions has gone down. It's now $86,000. So when I apply my 50% limit, I'm going to take the lesser of half the dividend, which is $50,000, or half the taxable income before special deductions. Well, that's now $43,000. It's $86,000 divided by 2. So now my limit is going to be the lesser of those two numbers. The lesser of those two numbers is $43,000, making my taxable income $43,000. Part C now asks how my answer would change if Theta's operating expenses are instead $272,000. So now in Part C, gross profit and dividends still haven't changed, so my gross income is still $320,000. My operating expenses have gone up, making my taxable income before special deductions $48,000. Now normally here I would go to my limits and I would say, okay, let's take the lesser of half the dividend or half the taxable income before special deductions. And that would be half of the taxable income before special deductions would be $24,000, and that would be the number I would use. But you see here, I used $50,000. Why did I do that? I did that because this limitation is not going to apply if the dividends received deduction would create a net operating loss. It does here in Part C. 48 minus 50 is -2, so my taxable income is -$2,000. It creates a net operating loss. In Part D, it says, how would your answers change if Theta receives $70,000 of these dividends from a 20% owned corporation and the remaining $30,000 from a less than 20% owned corporation? We know that the immediate change here is that when I own 20% up to 80% of a corporation, my dividends received deduction percentage is 65%. So for a portion of these dividends, the 65% limit is going to apply, and for a portion, the 50% limit is going to apply. When they both apply, we apply the 65% limitations first and then the 50% limitations. Okay, so in Part B, nothing has changed with gross profit, dividends, and gross income and operating expenses between what we did in Parts A, B, and C, because the only thing we're changing is the percentage of ownership. So the taxable income before special deductions will remain the same in A, B, and C as it did above. So I have started there. You can see in my Part B, I have started with taxable income before special deductions. Okay, so first we're going to do the dividends received deduction for the stock that's 20% owned. Remember, we received a dividend of $70,000 from the stock that is 20% owned. When we apply the limits here, our limit would be either half the dividend, or excuse me, not half, because this is 20% owned. So the limit would be 65% of the dividend or 5% of the dividend. The limit would be 65% of the dividend or 65% of the taxable income before the special deduction. So in Part A, 65% of $70,000 is $45,500. All right, and 65% of taxable income is more than that, of course, because taxable income is $102,000. So we're going to go with the 45,500. That's the limit that's going to apply. All right, now in Part A, we dealt with the 20% owned corporation stock. Now we need to deal with the less than 20% owned corporate stock. Remember that the dividend related to that less than 20% owned stock was $30,000. So the limit that is going to apply there is going to be the lesser of 50% of the dividend or 50% of the taxable income minus the entire dividend from the 20% owned stock. All right, so in Part A, the 50% of the dividend is easy. It's $30,000. So half of that is $15,000. To apply the second limit, 50% of taxable income minus the entire dividend from the 20% owned corporation, we would take $102,000 and we would subtract $70,000. So that is going to be $32,000. And then we'd apply the 50% limit to that. So 50% of $32,000 is $16,000. So in Part A, 50% of the dividend is going to be our dividends received deduction for the less than 20% owned stock, making our taxable income $41,500. In Part B, we started with taxable income before special deductions of $86,000. From there, we subtract the dividends received deduction for the 20% owned stock. All right, and again, our limits are going to be 65% of the dividend, which is $45,500, or 65% of the taxable income before special deductions, which in this case is $86,000. So 65% of that is $55,900. $45,500 is still smaller, so for the 20% owned shares in Part B, our dividends received deduction is going to be $45,500. Now, for the dividends received deduction for the less than 20% owned shares, you can see in the box, I have a little box with an arrow. We kind of did that up here. So we know the 50% rule tells us either half of the lesser of half of the dividend, which the dividend was $30,000, so $15,000, or taxable income before special deductions minus the entire 20% owned dividend. So you can see in Part B, we have $86,000 minus $70,000. That's going to equal $16,000. I take that times half, times 0.5, and I get 8,000. So the limit is the lesser of $15,000 or $8,000. So 8,000 is smaller. That's the limit that is going to apply in Part B. In Part C, our taxable income before special deductions is $48,000. So first we're going to apply the 20% owned dividends received deduction. And our normal limits are 65% of the dividends received or 65% of taxable income before the special deduction. But remember, our limit is not going to apply if the dividends create a net operating loss. And here the dividends are going to create a net operating loss. So we're going to be able to deduct 65% of the 20% owned dividend and 50% of the less than 20% owned dividend to make my taxable income negative $12,500. That is a net operating loss. And moving on to net operating losses, this is the next special deduction we're going to discuss. These are going to arise when expenses exceed gross income. There's not a lot of reconciliation here. The only adjustment that's made to expenses is for net operating losses from previous years. I can't factor those in when I'm considering the net operating loss for this year. The net operating loss may be carried forward indefinitely, but it's limited to 80% of taxable income before the net operating loss deduction for the current year. So as you've probably realized as we're going through this, a lot of these calculations depend on net operating losses, dividends received amounts, and charitable amounts. So the order in which we compute these becomes important. We have to compute them in this order. First, we compute all deductions other than the charitable contributions deduction, the dividends received deduction, and the net operating loss deduction. Next, we compute the charitable contributions deduction, then the dividends received deduction, then the net operating loss deduction. We do this because the charitable deduction is limited to 10% of taxable income before the charitable contributions deduction and the dividends received deduction, but after any net operating loss carryover deduction. Once I determine that, I can add back any net operating loss carryover deduction and then subtract the charitable contribution deduction before computing the dividends received deduction. The corporation would then subtract the net operating loss deduction subject to the 80% of taxable income limitation to arrive at taxable income. So let's do some problems to practice this ordering. First, we're going to look at Delta Corporation. They incur a $100,000 net operating loss in 2018. In 2019, they report the following items. Even though the numbers in this problem are small, we're going to assume Delta doesn't qualify for the small business exemption from the net business interest limitation. And you might look back at that. We talked about net business interest and what is deductible in previous slides. So A, what's the taxable income in 2019? Okay, so we know the limits that we need to worry about, the special calculations we need to make are the business interest and then the net operating loss. So we obviously always start with gross profit. They gave that to us. And they also gave us operating expenses. These are our normal deductions and losses. So we end up with taxable income of $80,000. Now we have this business interest expense. That is a normal deduction and loss, but it's subject to limitation. So over here in the box to your right, I have the limitations here. Net business interest is limited to the sum of business interest income, which I don't see any of that here, 30% of adjusted taxable income, and then floor plan financing interest. We don't have that here. And I have a note, this limit is not applicable if you are under the 25 million gross receipts test, but in the problem it says we are not under the 25 million gross receipts test. So we don't have business interest income and we don't have floor plan financing interest. All we have is the 30% of adjusted taxable income. So I look at my $80,000 taxable income. I take 30% of that to arrive at my business interest expense deduction of $24,000. You see that I incurred $30,000. I can only deduct $24,000 this year. My taxable income before my net operating loss is $56,000. Now I have this net operating loss. My net operating loss is going to be limited to 80% of taxable income before the net operating loss. So I take that $56,000, multiply it by 0.8, that's $44,800 that I can deduct this year, making my taxable income $11,200. Part B, what are their carryovers to 2020? Business interest has a $6,000 carryover, and my net operating loss has a $55,200 carryover. In problem 44, we have Beta Corporation reporting the following results in the current year. In addition, they have a $10,000 net operating loss carryover from the preceding tax year. We first want to know the taxable income for the current year. All right, so here we have charitable contributions, we have dividends, and we have a net operating loss. So the sequencing is going to be very important here. But if we're determining taxable income, we start our tax formula at the top. We start with gross income of 180, that's given to us. We also have dividends of $100,000. That's part of gross income. So our gross income is $280,000. We're also given our operating expense number. So we subtract our operating expenses of $150,000 to get $130,000 of taxable income before charitable deductions. All right, and we start, remember in our ordering, we start with all the deductions other than charitable, dividends received, and net operating loss. So we did that. Next, we do the charitable contribution deduction. So my first little star over here to the right, under charity, remember it's limited to 10% of taxable income before charitable carry forward and dividends received deduction, but after the net operating loss carry forward. Okay, so our charitable contribution amount is $20,000. Now that's remember we measure it by determining what kind of property it is in our hands, whether capital or operating, and we decide if we measure it at fair market value or adjusted basis. They've already done that for us. They've looked at all the things that we donated and measured them for us, and they measured them at $20,000. So we need to see what limit is going to apply. We look at taxable income before charitable carry forward and dividends received deduction, but after the net operating loss. So we have $130,000 of taxable income now. We subtract that net operating loss of $10,000, which is given to us. We have a net operating loss carry forward of $10,000 to get $120,000. Then we apply our 10% charitable limit to that amount. So our charitable deduction is $12,000 this year. In our sequencing, the next thing we do is the dividends received deduction. So we need to look at how much we own of this corporation. It says we own less than 20%. So we know the 50% limit is going to apply. So we look at 50% of the dividends or 50% of taxable income before special deductions after charity. So we take this $130,000 minus the $12,000 charitable deduction, multiply that by 50%. That's $59,000. So remember, I take the lesser of the two. The lesser of those two numbers is $50,000. My dividends received deduction is $50,000. So now I'm at taxable income before net operating loss, and net operating loss is the last thing I do in my sequence. So my net operating loss is going to be equal to, or limited to, 80% of taxable income. And when they say taxable income, they mean taxable income after charitable deduction and after dividends received deduction. So we have $62,000. 80% of that is $54,400. But my net operating loss is only $10,000. So I get to take the full $10,000 net operating loss, making my taxable income $52,000. Part B, what carryovers are available to other tax years? We used up all our net operating loss, but we did have that charitable contribution that was limited. It was valued at $20,000. I was allowed to deduct $12,000 this year, meaning I have an $8,000 carryover for 5 years, if I can use it up in 5 years. If not, I lose it. In problem 51, we have Roper Corporation reporting the following results for the tax year. We want to know Roper's taxable income and income tax liability. So you see we have capital asset transactions, we have dividends, we have a net operating loss. So we're going to have to do a little bit of ordering, and we're going to have to pay attention to our capital asset transactions. When I want to know how much tax I owe, I start at the beginning of my tax formula. I always start with gross income. So gross income is going to include my gross profit, it's going to include my dividends, and it's going to include my capital asset transactions. So you see that we have short-term capital gain and long-term capital gain. I can net those together because I don't have favorable tax rates this year for long-term capital gains. So when I add all of those amounts together, they're all items of income. I get $160,000 of gross income. From there, I subtract my deductions and losses. So I have $45,000 of operating expenses, leaving me $115,000 of taxable income before special deductions. Now let's think to our sequencing. In the special deductions, we started with charitable contributions, and then dividends received, and then net operating loss. We don't have charitable contributions here, so we're going to start with the dividends received deduction. And here we own 25% of this corporation, so the 65% limit is going to apply. The dividends received deduction is the lesser of 65% of the dividend, which is $15,000, or 65% of our taxable income before special deductions, which is $115,000. So the smaller of those two numbers are $9,750. So my dividends received deduction is going to be $9,750, making my taxable income before net operating loss $105,250. My next item in the list is my net operating loss. Remember, that is limited to 80% of my taxable income before the net operating loss, or the actual net operating loss. So my taxable income before net operating loss is $105,250. So 80% of that is clearly more than the $9,000 net operating loss. So I get to take all of the net operating loss, making my taxable income $96,250. And my tax liability, remember, is my taxable income times the flat tax rate of 21%. So $20,213. We also have some limits that apply to controlling shareholders. So if I have a transaction between a corporation and a controlling shareholder, there may be limits. And a controlling shareholder means they own over half of the corporation, including constructive ownership. So those rules are found in Section 267. Remember, they are family attribution, corporate attribution. We are treated as owning shares that people or organizations we are related to own. So if I own over half of a corporation, either directly or through constructive ownership, these limits are going to apply. The first is found in Section 1239A. It's going to convert a capital gain on a sale of property that's depreciable to the purchaser from the controlling shareholder to the corporation from capital gain to ordinary gain. So instead of getting that beneficial tax treatment, I'm going to have to pay the ordinary tax rates. Section 267A1 is going to disallow a loss on a sale between related parties. The loss is going to be deferred to a later date if the property is sold at a gain. So this makes sense because if I say I as a taxpayer for some reason can't take that loss, but my related party corporation can take that loss, I might sell that, not get to take the loss, but preserve the loss for later. Section 267A2 is going to disallow a deduction between related parties when they use different accounting methods. So a deduction by an accrual method taxpayer may not be taken until the cash method taxpayer reports the payment as income. This also makes sense because an accrual method taxpayer can take a deduction for an expense when it's owed but not yet paid. But the cash method taxpayer won't report the receipt as income until they actually get it in their hands. So without this rule, this accrual method taxpayer could continue to take deductions, and there'd be no corresponding recognition in income if they hadn't actually paid the expense. There's also limitations where the at-risk rules apply. We'll talk about that in Chapter 9. The passive activity rules are going to apply to personal service corporations and closely held C corporations where 5 or fewer shareholders own more than half the value of a corporation.